86% of SCHD's holdings are sitting inside another dividend ETF. And almost nobody talks about it. 572 companies, $73 billion in assets. And as of last month, it costs less than SCHD to own. If you've been building a dividend portfolio around SCHD, this isn't going to make you feel great. Because the fund I'm about to break down doesn't just overlap with your favorite ETF. It might actually be doing some things better. And I'm not saying that to be dramatic. The numbers over the last 5 years tell a story that most dividend investors haven't heard yet. Quick disclaimer. I'm not a financial advisor, and this isn't financial advice. Always do your own research before making any investment decisions. Today I'm going to walk you through exactly what this fund holds, why Vanguard just made it cheaper than almost anything else on the market, and how its recent dividend raise is sending a signal that income investors need to pay attention to. But the real comparison, the one that might change how you think about your SCHD position, that's coming later. And it's not what you'd expect. The fund is VYM, Vanguard High Dividend Yield ETF. And the first thing you need to understand is that VYM and SCHD are not the same thing. Even though they share most of the same companies, here's the difference. SCHD takes a scalpel approach. It screens the entire market and picks exactly 101 stocks based on quality metrics. Things like return on equity, cash flow to debt ratio, and dividend growth history. It's selective, it's concentrated, and that's exactly why people love it. VYM takes the opposite approach. It tracks the FTSE High Dividend Yield Index, which essentially takes every large cap stock in America that pays an above-average dividend, and buys all of them, weighted by market cap. No quality screens, no concentration bets. Just, if you pay a decent dividend and you're big enough, you're in. That's why VYM holds 572 stocks compared to SCHD's 101. And that's why 86% of SCHD's holdings appear inside VYM. But only about 15% of VYM's holdings appear in SCHD. One contains the other, plus 470 additional dividend payers. Now here's where it gets interesting. When you hear dividend ETF, you probably picture banks, oil companies, consumer staples, boring stuff. And yeah, VYM's second largest holding is JP Morgan at 3.63%. Exxon is in there at 2.71%. Johnson & Johnson, Walmart, Procter & Gamble, all the names you'd expect. But VYM's number one holding? Broadcom, at 6.95% of the entire fund. A semiconductor company. The biggest position in a dividend ETF. That doesn't sound right. Until you realize what happened. Broadcom's stock price has exploded because of artificial intelligence demand. But here's the thing. Broadcom also raised its dividend by 11% in 2025. So its yield still qualifies for VYM's threshold. And because VYM is market cap weighted, Broadcom's massive price appreciation pushed it to the top. This means VYM quietly became one of the few dividend ETFs with serious tech exposure. Without anyone really noticing, it's not just banks and oil anymore. But the reason VYM is suddenly getting attention isn't Broadcom. It's what happened in the fourth quarter of 2025. VYM's quarterly dividend jumped from 84 cents and 17 cents per share to 94 cents and 74 cents. That's a 12.56% increase in a single quarter. And for a fund this massive, $73 billion, that kind of jump doesn't happen quietly. Now, I need to be honest about something, because most channels won't tell you this part. That 12% raise is quarter over quarter. It's the Q4 payment compared to Q3. When you look at VYM's total annual dividends, 2025 paid $3.50 per share. 2024 paid $3.49. That's a year-over-year increase of 0.18%, basically flat. So why did Q4 spike? Because VYM's underlying companies, Broadcom, JP Morgan, Exxon, AbbVie, Procter & Gamble, all raised their dividends throughout 2025. The fourth quarter distribution also includes year-end true-up payments and special dividends. Q4 is always the highest quarter for VYM. This one just happened to be notably higher than Q3. Does that mean the 12% number is meaningless? No. It shows that VYM's underlying holdings are generating more cash and returning more to shareholders. That's genuinely positive, but calling it a 12% dividend raise without context would be misleading. And you deserve better than that. Now let's talk about the move that should have been front-page news for every dividend investor, but barely registered. In February 2026, Vanguard announced the largest fee cut in its history. Nearly $600 million in annual savings across 84 fund share classes. And VYM was one of them. Its expense ratio dropped from 0.06% to 0.04%. That makes VYM cheaper than SCHD. SCHD charges 0.06%. VYM now charges 0.04%. On a $100,000 investment, that's $40 a year. On $500,000, $200. It's almost nothing. But the fact that the bigger, broader fund is now the cheapest option in the category, that changes the math for a lot of people. And this is where the conversation gets really uncomfortable for SCHD loyalists. Over the last 12 months, VYM returned 18.28%. SCHD returned 15.34%. VYM wins by almost 3 full percentage points. Stretch that to 5 years. VYM's annualized total return is 12.23%. SCHD's is 9.69%. That's not a rounding error. VYM has been crushing SCHD over the medium term. Now, SCHD does win on some things. Its current dividend yield is 3.37% compared to VYM's 2.32%. If income today is your priority, SCHD pays you more per dollar invested. SCHD's 10-year annualized return is 12.8% versus VYM's 11.74%. So over a full decade, SCHD has a slight edge on total returns. And SCHD's dividend growth rate is significantly higher, around 8 to 9% annually versus VYM's 3.2%. So this isn't a case where one fund is clearly better. It's a case where two funds that share 86% of the same stocks produce meaningfully different outcomes depending on your time frame and what you care about. Let me show you what this looks like with real money. Harry puts $100,000 into VYM. Based on the current trailing 12-month yield of 2.32%, Harry could potentially collect about $2,320 per year in dividends. That works out to roughly $580 every quarter, or about $193 per month if you spread it out. Compare that to VOO, the S&P 500, where the same $100,000 would generate only $1,140 per year. VYM potentially doubles your income over VOO. Now, if Harry reinvests every dividend and VYM continues to perform near its 5-year historical average of 12.23% total return, that $100,000 could potentially grow to around $178,000 in 5 years. By year 5, Harry could be collecting over $4,000 per year in dividends, roughly $344 per month. Stretch it to 10 years using VYM's 10-year historical average of 11.74%. And Harry's $100,000 could potentially reach around $303,000. With annual dividends that might approach $7,000, nearly $587 per month in passive income from a single ETF. But here's the trade-off you need to understand. If Harry put that same $100,000 into VOO instead, the S&P 500's stronger growth rate means he could potentially end up with over $400,000 after 10 years. That's roughly $100,000 more than VYM. The total wealth gap is real. So why would anyone choose VYM? 3 reasons. First, diversification. 572 holdings with no single stock above 7% means VYM is one of the most diversified dividend funds in existence. Your risk to any one company blowing up is minimal. SCHD's 101 stocks carry more concentration risk. Second, income stability. VYM excludes REITs entirely, which means no REIT tax complications and a cleaner corporate dividend stream. The fund also uses a buffer zone system for adding and removing stocks. Current holdings stay until their yield drops below the 55th percentile, and new stocks can only enter above the 45th percentile. That reduces unnecessary turnover and keeps things tax efficient. Third, and this is the one nobody talks about, if you already own VYM, you essentially own almost all of SCHD. 86% of SCHD's stocks live inside VYM. So pairing VYM with a growth fund like VOO could give you broader dividend exposure than SCHD. Plus the growth engine. For less in fees, the real question isn't whether VYM is better than SCHD. It's whether you understand what you actually own, and whether your portfolio is built for where you are right now or where you want to be in 10 years. A fund that holds 572 dividend-paying companies, costs $40 a year on a $100,000 portfolio, and just watched its underlying holdings raise dividends across the board. That's not something to ignore, even if it doesn't have the cult following that SCHD does. If you want to see how SCHD stacks up against another overlooked international dividend ETF, that video is right here. And if this changed how you think about building a dividend portfolio, drop a comment. I read every single one.